Hey, it's Eric Ludwig here from Stockbridge Private Wealth Management. I thought I'd switch things up a little bit and record a video instead of writing the newsletter. I haven't done one of these podcast type or videos in quite a few years, and I also just didn't feel like writing. So that'll be more fun to make it feel like we're interacting and do a video. Um, so I'll do some market updates like I normally would, talk about some changes in some retirement planning laws that have been important, and then I'll share a personal milestone that means a lot. So let's just get into it. So looking back, I always like to look back at what the market's been doing. It's been pretty crazy, right? So from January 1st through September 30th of this year of 2024, it's been pretty crazy actually. It doesn't feel like it, but the stock market, the S&P 500 is up about 19% for the year, and that's not a miss speaking. It's up almost 20%, and the Nasdaq, which is mostly technology-based companies, is up about 17.5%. So it's been pretty impressive, especially with all the news cycle that's been going on and some of the economic headwinds that we face. There's something that's been kind of flying under the radar, which is bonds. Bonds don't really get talked about that much, but if you look at a bond index that most people follow is the Bloomberg US Aggregate Bond Index. So that's kind of a snapshot of all bonds in the US. That's up about 2% for the year. And I know that's nothing to really write home about, but if we go back to 23 and 22, bonds really took a beating, and bonds were actually negative through about May of this year. So the fact that they've rebounded and are up 2%, that's at least something meaningful. A lot of us, not me personally, but a lot of people that are retired anyways, have bonds in their portfolio, and it's nice to see them actually doing something positive finally. So the big economic news has been the Fed, and they finally did a interest rate cut, and they did a full 0.5% or 50 basis points, which is a pretty big deal. They've talked about doing two more rate cuts for the rest of the year, actually. And I actually got to listen to one of the voting members on the Federal Reserve Board. I got to actually speak with one of them back in August. And anyways, they're talking about two more rate cuts for the end of the year, which has been interesting because normally inflation has been the big boogeyman, right, the last couple of years. And so it's nice to see that they're looking that the interest rates have started to taper off. So that's pretty cool. Jobs remain pretty tight. I think the unemployment rate, I think, is still at like 4.2%. So that's really strong. And all in all, I mean, it's hard to complain about what's been going on in the market. So what I want to do is kind of that's looking back. When I write the newsletters, I usually talk about so what? What do we want to look at going forward? I think I heard there was some kind of election or something like that going on. So that's on everyone's mind. And the common question I get is there something I should do with my portfolio either now or after? And I'll tell you something that probably isn't going to surprise you. And I wouldn't really do anything. And the reason is here's what's interesting to me. If you survey investors, what you find is that if you're, say, a Republican, or it doesn't matter, whatever party you want to win, if you survey them after the election, if their party did win, they feel very optimistic about the economy and the markets. If their party lost, they feel very bullish. And it's funny because if you see this in the election cycle where, say, leading up to the 2020 elections, Republicans were very optimistic about the markets until Biden won. And then all of a sudden they're pessimistic. And it's the same thing 4 years prior. Democrats very optimistic about the markets and the economy until Trump wins. So it's just kind of funny to me. The big picture is that regardless of who's in control, there's so much political noise that really what drives markets isn't who's in office, it's what companies are doing and how consumers are spending their money. So it is important just to kind of remember that. The other thing is there is something that is important is that that's the TCJA, the Tax Cuts and Jobs Act, is actually set to expire in 2026. And one thing where the elections will matter is whoever ends up in charge is going to make a difference, probably on some things related to income tax rates, estate tax exemptions, and some other things. And that really does justify some proactive tax planning. So it's not to say that it doesn't matter who wins the election on the markets. That's true. But I think there'll be some bigger things that we won't know how to plan until we find out who's in office and how these Tax Cuts and Jobs Act expirations will matter, and we can plan ahead. So there's things like Roth conversions, some accelerated gifting, some things like that that might be helpful to look at. In terms of interest rates, the big thing I wanted to point out, the yield curve is actually still inverted. So what's really weird is if you look at the 3-month Treasury bill, is actually paying more than if you were to lock your money up for 30 years in the same Treasury government bond. So it still pays to be on that short end of the maturity kind of length. And that's where we've been the last few years. And I still think that's the place to be until some of these rates get more settled out. And once the rate curve normalizes, then there's some other things that we can do, but we'll talk about that once we get there. The other thing is RMD. So Secure Act 2.0 changed the RMD age, the age at which you have to start taking distributions from your qualified accounts, and they bumped it to 75 now. So if you remember, it was always 70 and a half. They bumped it to 72, 73. Or sorry, it is 73 now, and it's going to go out to 75 for people that turn 75 and later after 2032. So I know that doesn't apply to many of you, but for a lot of you, there was actually quite a few of us that we had were planning to take RMDs at 72. It got pushed to 73. So that's been kind of a big deal. Okay, here's something I'm super excited about. Stockbridge, the company, turned 10 in August. So it's crazy to me. I can't believe that 10 years has gone by. Many of you that are watching this, we've been working together for not only just that 10 years, but even prior to that. Some of you, I started at the bank in 2007, and we've been working together since then. So that means a lot to me. That's 17 years. I was looking at some old files. I found the very first newsletter that I ever wrote. And I'm just going to read this because this stuck out to me. And it said that I wrote, we focus on relationships first, making sure that we really understand what our clients' goals are in life so that we can manage wealth accordingly. We listen, we're client-centric, we're passionate about helping clients, and my duty is not to make money for an employer or to hit a sales goal like many in this industry have the pressure of. It's only to make money for you. And reading that today, I'm just so filled with like a sense of pride and honestly a bit of awe. I can't believe 10 years later, I mean, all of those things they still really ring true. And it's just not a mission statement for us. It really is how we've lived every day since Stockbridge. You know, starting the firm was a big leap into the unknown. I was doing really good at my last employer. And so it was exciting, but also nerve-wracking. And I don't know if I've told many of you this before, but 2 days after I started the firm, my old boss called me and said, "I hope you beep and fail." And then he hung up. And I can't believe that. That was the guy that was my mentor. Um, but anyways, this isn't about me. The whole thing is it's about you. And every time one of you reaches a financial goal, it really means a lot to me. It's so awesome to be part of that journey together with you. And I look forward to the next 10 years and the next 10 years. So I just want to say from the bottom of my heart, I really do truly appreciate it. And it's meant a lot, not to just me, but to my family as well. Some other things, just other updates that have been kind of cool and in the family side of things. I've been putting my PhD to good use. I think I've spoke at like 15 different conferences this year, and it's been all around the country. In 1 week in May, I was in Tucson, Arizona, Dallas, and Fort Lauderdale, and that was in 1 week. That same month, I think I was also in Washington, D.C. I've now been there twice this year. I've been in Atlanta, Indianapolis, Columbus. and so on and so on. The cool thing was the highlight for me is I got to speak twice in New York City. And so once was actually at a press event in that was back in February, and it was for this retirement income literacy research that I was on a team of, and I kind of led the research for it, but it was for the American College of Financial Services. I got to go back to New York City in April, and I got to be a panelist as a retirement income expert for a show that was being taped at the Nasdaq. So it was literally, if you've ever watched like CNBC and watched Kramer's show, I walked right past where he records it. It was right down the hall from where we got to record ours. It was right on Times Square. So it was like, anyways, you can look on YouTube. There's a video of it. It's pretty cool. I've gotten to be in quoted in Barron's, Wall Street Journal, Forbes, Investment News, and some other publications this year, which has been really neat. But most importantly, if you know me, my family's always number one. So my daughter Alex has been kicking butt as a third grader, and I mean that almost literally. She's been kicking butt in Taekwondo. She'll just be testing for her blue belt here in just a couple days, and which will put her in the advanced category. So she's only like a year and a half away from testing for her black belt, which is cool. She's been keeping us busy. Karen and I both coached together on her softball team this summer, which was really fun. Being in those dugouts is pretty hilarious with a bunch of 8, 9-year-old girls. And then I also coach her basketball teams. And also the tall girl genes are kicking in for her. And she even tried volleyball over the summer and has been enjoying that. So that's been cool. I got to take my family on a couple of those trips with me this summer or throughout the year. And so we've gotten to do some sightseeing, which has been fun. My parents are here. They've been here for the summer. They're going to go back to Florida on Halloween, and they'll be back for the holidays. And I think that's where I'll leave it. So until then, I hope that you enjoy your holidays. You know that I'm always a phone call or an email away. And so again, just reach out. And again, I can't thank you enough for having spent, however long that I've worked with you for. And like I said, for some of you, it's 10 years. Some of you is as many 17. So I hope it's another 10 or another 17. So thanks a lot and have a great rest of the day.